Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Kevin Cummins and Joann Spadigam. Okay, a major week for central banks. I was going to say the most interesting, maybe before the week began, the most interesting we thought was going to be the Bank of Japan, but that's not something we touch on in lots of detail in this podcast. So maybe the second most interesting then was the Fed, and perhaps we should start there, Kevin. There was lots of kind of chatter heading into the meeting around the Fed's updated projections and their dot plots and how they may or may not get changed. Can you kind of give us your high level takeaways, I suppose, and your take on whether there are any surprises or not within those dot plots or anything else from this week's Fed meeting?
Sure. Yeah. Thanks for having me. And, I think you captured it right. Going into the meeting, the focus, I think, was on whether or not the Fed was going to, in the wake of the stronger than expected data that we've seen so far in 24, particularly with regard to core inflation. It's widely advertised that we started the year with kind of an above trend reading in January, and by all indications, February looks a little firmer than the earlier trend. So, is it enough to have shifted the Fed's expectation of how much cutting they could potentially do this year by year end? So, the way the dot plot was designed in December, it was a pretty widespread dispersion of dots between whether or not officials thought 2 cuts or 3 cuts or 4 cuts, and a very similar number of members were in each of those camps. But behind the scenes, if you were to look at the dispersion of dots, there was an upshift, a bit of an updrift within the dots themselves. That I guess they're a little less dovish than they were in December, but not all the way enough to change the median for this meeting. So, I think coming away from it, the backdrop hasn't changed all that much relative to what officials have been signaling. And I think that's a fair assessment. I mean, it seems like, in our view, the inflation scare we saw in January and February is going to be a one-off. But even Powell said in his press conference, you can't ignore the fact that, yeah, maybe it was exaggerated, but you can't ignore it, and we're taking everything into consideration. So, there were a few subtle changes in his tone that maybe were a little less dovish than he was, prior to those data.
And how does that leave your kind of overall view, I suppose, of policy over the next couple of months?
Our forecast is that they're going to start cutting rates in June. So we did not change our expectation there. I think there's a perception amongst market participants to assume 3 rate cuts this year, if you take the Fed's forecast literally. And that would probably mean, because there have been a couple, for example, Atlanta Fed President Bostic has kind of floated the idea that they don't have to go at every meeting, that they can cut rates, see how things evolve, and then cut rates again. Our forecast doesn't think that's the most likely scenario. But market participants, I think, if they were to have seen a change in the dot plot to only show 2 cuts, would implicitly signal that it's going to be a later start. So the earliest the Fed could potentially cut, according to the dot plot, if you took it literally, would potentially mean then they would go at the September meeting and the December meeting. Now the Fed will do what the data require, but I think there's some reason to wait to the end of quarter meetings as a favored, when you could potentially start change in policy, that this, easing cycle would begin, and allow that to show it through an updated dot plot. You have the press conference, and there's a package of information that they can clearly communicate and make very transparent their expectations of where they see things. I think ideally they would like to go at the end of every quarter if given the opportunity that the data, cooperate with that sort of expectation. So I think the market would think that if you only saw two dots, then they probably would have assumed September and December, a later start. And then that would potentially remove the optionality of going in June. So we kept our expectation that June is still on the table. Our forecast is much more aggressive, than 5 cuts this year of 125 basis points, as opposed to 3 cuts at 75, is our expectation for inflation relative to the Fed. So the Fed yesterday raised their core PCE price estimate for the fourth quarter of this year from an earlier 2.2% as of December last year when they made that estimate, to 2.7. So they have a higher trajectory than they did 3 months ago. Our forecast actually goes in the other way, where we have core inflation coming down at 2.2 this year by the fourth quarter on a Q4 over Q4 basis. So we're a half a percentage point lower. And if you want to get into the details, we're assuming softer 0.2s than what they're assuming. One thing that Powell mentioned in the press conference was the January PCE data are actual. The February data, like the Fed, we also cobbled together based on the CPI and the PPI, a PCE forecast, which we have at 2.8% as of February. It so happens that Powell also mentioned for the February year-on-year core PCE is at 2.8 in their estimate. So that would, if you assume where do you got to be to go to 2.7, they're assuming 0.2 every month on average. So there may be a month where you're 0.3 and another 0.1, but on average you're 0.2. Similarly, we're a softer 0.2, so we actually have inflation ending this year going down further from 2.8 to 2.2, rather than only a little bit more progress to 2.7 in their forecast from the currently reported 2.8. So they implicitly kind of have a little bit of a stall, at least in the year-over-year projection on inflation, even with some improvement on a month-to-month basis. I don't, one of the things was he didn't mention something that he did in his congressional testimony about having that. He did mention that they want to make sure they have that confidence before they start cutting rates. But up until yesterday, he was saying that we're getting close to gaining that confidence. Yesterday, he didn't refine it so specifically. And it's not that surprising because there is some uncertainty in the wake of the stronger than expected January and February. But, I think they're waiting patiently to see. And then once they presumably see a resumption of their earlier downtrend, then they can start cutting rates. And I on the upside, when you're hiking rates, maybe you feel like, if you hike rates and then you kind of see how the market takes it and how the economy responds, you don't want to necessarily stall out a soft landing. So on the downside, if things are starting to show some signs of weakening, like we think on the broader economy, it doesn't really make sense from a on again, off again kind of rate cutting cycle when you're restrictive. And if things are pretty soft, which, they probably aren't going to be given that option in our view to hold off from cutting at every meeting. So that would be the difference in the discrepancy between our aggressive forecast of 125 basis point rate cut once they get started versus theirs, which is potentially like an off again, on again sort of easing.
We also heard from the BOE today, of course. Imogen, what are your latest thoughts on the Bank of England and what do we learn from today's decision?
Yeah, I guess listeners that listened to last week's episode or have read our preview on this will know that we were expecting this to be a very kind of unchanged placeholder meeting. I think we said unchanged on rates, unchanged on forward guidance, and unchanged on the vote. Although, of course, we did note that the vote was where the sort of wiggle room would be and ultimately what might drive the market reaction. So that shift in vote did actually materialize. You got the two hawks, so Mann and Haskell, voting for unchanged rates rather than for a vote rather than for a rate hike, which they had in February, which gave the vote 8-1. So Dhingra still continuing to be the sole member voting for a cut. I think I read that this was the first time that no MPC member has voted for a rate hike since the end of 2021, I suppose, when the rate hiking cycle began. So, on the surface, it looks quite a symbolic shift from the BOE not having any member voting for a rate hike. But it's probably a bit more symbolic than anything else. And I wouldn't want to overstate the kind of dovish takeaways from today's meeting just off the back of that vote. What the hawkish fringes of the committee are voting for is much less relevant than what the kind of centrist 5 or 6 are actually voting for. And in that context, the rest of the guidance, the forward guidance around kind of still needing to see more evidence that this persistence price pressures are alleviating remained intact. So I'm not sure that we're necessarily any closer to rate cuts just because those two hawks have now switched their vote. A couple of things I would just highlight that I think also fed into the market's perception of this being a dovish meeting. Not that they were changes to the kind of official guidance, but more kind of formal additions to the minutes. The first was this line that we've heard frequently over the last couple of weeks in speeches and interviews and that sort of thing, but it wasn't kind of formalized in the minutes at the last meeting, that rates could still be cut and policy would remain restrictive. And the second one was this introduction of the line that, essentially implies that every meeting is live. I think it says that the MPC will kind of reassess their decision on how restrictive rates need to be on for how long at each meeting. Again, that was something that was sort of alluded to by Bailey in the Q&A at the February meeting. And of course, in essence, every meeting is sort of live. They recalibrate their policy outlook based on the new information that comes to light every 6 weeks. But I think formalizing it just added to the sense that, at near-term meetings, they will be thinking about whether that's the right time to cut rates. I think the dovishness of those elements, though, was a little bit offset by the fact that, like I say, what the kind of dovish or even hawkish fringes are voting for is somewhat irrelevant. We have to consider what the centrist members of the committee are looking for. B, also the fact that although Mann and Haskell did vote for unchanged rates this time, the minutes seem to register very similar concerns from the kind of hawkish end of the unchanged rate spectrum, which was around the persistence of wage inflation, still very high service price inflation. And so it didn't feel like fundamentally their view of the skew of risks had actually shifted, despite the fact that they had changed their vote. And then C, also, it doesn't change the fact that this is still a data-dependent committee. Like I said, the guidance in the minutes was very much still one of the data is trending in the right direction, but we need to see more of it. And so although the immediate market reaction was to kind of bring forward some of that bank rate cut pricing, actually, we can't bring forward the publication date of this data, and it's a known fact that we won't have very much more data by the next meeting, by the May meeting. We'll only have one more set of wage data, so that's for February, and it won't be until the June meeting that we have the first look at the kind of April wage data, which is only then will the committee have a real complete picture, I suppose, of the early year wage negotiation process in the UK. So I think it was a probably marginally more dovish meeting than we had expected, certainly given that shift in the vote. But I think the takeaway really is that I wouldn't kind of overemphasize this dovish shift from the committee. And I think really all the shifts in the minutes have just been about formalizing what we'd already heard in an informal way in lots of speeches and press interviews, etc., over the last couple of weeks.
Are there any implications for your views on markets or your August cut?
The short answer is no, it doesn't really change our view in terms of the path for bank rate. As a reminder, our central scenario has long been, i.e. since last August, has been for the first cut not until August of this year. We think that today's, like I say, the echo of the fact that we need to see more data, plus the kind of marginal fiscal easing and the impulse from the budget, both reinforce this idea that cuts are likely to come later rather than earlier, we think. And our base case remains that we get, we think at this stage, 100 basis points of easing this year. I don't think May is any more likely today than it was yesterday, largely because, like I said, we won't have the right data by May. I think, if I had to put a number on it, I would ascribe probably only a 10% probability to a May hike. Perhaps June becomes slightly more likely, but I think market pricing for a cut in June is already quite close to fair. By June, the market, certainly at the time of the recording, has about just shy of 20 basis points being priced in by June. So to me, the biggest mispricing, and I think we spoke about this last week when it comes to the market, is still in the extent or the lack of easing that's being priced into the second half of this year. The market still only has about 60 basis points being priced in. That's moved a little bit following the BOE decision today, but not a huge amount. And that feels very low. If you genuinely believe that the BOE can get off the mark by June, I think that there's every chance that they can deliver more than 60 basis points of easing. And even if they don't go until August, in line with our central view, that still looks quite low. That's suggesting only shy of 2.5 cuts over 4 meetings. And perhaps they don't go at every meeting, especially initially. And I think we'll come on to the ECB, but we heard that as perhaps a policy path from Lagarde yesterday. But I still think that if they're able to start easing policy as soon as August, they will be able to deliver more than 2.5 cuts by the end of the year. Of course, a big driver of that kind of relatively more hawkish pricing has been the market's perception, or I would argue misconception, around this idea that all kind of major central banks are in the Fed slipstream, and therefore, if the US data keeps surprising to the upside, it's going to be more difficult for the ECB and for the BOE to ultimately cut rates as much as we're expecting. Like I say, I think that's a little bit of a misconception. Of course, I accept the fact that these, major central bank policy shifts do tend to happen in a somewhat coordinated fashion. But I think the domestic data backdrop matters much more for the Bank of England's reaction function than what the Fed is doing. And, perhaps if we were in a scenario where we didn't think the Fed was cutting rates at all this year, against that backdrop, you might argue that it would be difficult for the BOE to get in more than, 2 hikes. But given, as we've just heard from Kevin, we do think that they will be cutting rates more than a couple of times. I don't think it's unreasonable to think that the BOE could also be cutting at least 3 times between August and the end of the year, if they're going in 25 pip increments. Of course, the longer that they leave those cuts, the more likely it becomes that they move in slightly bigger increments, perhaps 50 basis points. The other kind of market takeaway, I suppose, for me, which is not just about today's Bank of England meeting, but also about the data that we've had this week, the inflation data and the public finance data, as well as a kind of dovish leaning Fed, I suppose, in the sense that they didn't change the near-term dot plots. All of that combines to me to reinforce my conviction around a curve steepener. If markets aren't pricing enough in terms of what now appears to be a relatively more dovish view on the Bank of England, plus you still have these supply concerns, which might be somewhat re-emphasized over the next couple of weeks if we get a look at March's borrowing data, which shows that actually the government has overshot its borrowing needs for this year and may need to issue slightly more gilts than we had expected. And you add that to the fact to the reasons already why we think that the gilt remit for the year ahead should be an impetus to a curve steepener in terms of the skew of that issuance across the curve, with still plenty of longs despite the long bucket being cut proportionally. And the fact that we still think the risks are skewed to the upside anyway, given that borrowing data is based on fairly optimistic growth projections by the OBR. And I think all of that combines to, like I say, reinforce our conviction on the curve steepener. So that's the one market move today, which I think is really a go with, and I would expect to see that to continue over the next couple of weeks. But that's probably enough from me. Joann, anyone that's watching this will be able to see that you have your hotel room in the background because you're recording this on your travels. You and Gio have been out and about seeing lots of clients over the past couple of weeks on the continent. What have been the key discussion points and your key takeaways from those meetings?
So we've been talking quite a lot about the ECB, but also about the Fed in that regard. I do think there is this concern, similar to what you said, Imogen, on the UK, also in the euro area, in terms of the Fed perhaps setting the pace or the timing of cuts for global central banks, including the ECB. So the question we've got quite a lot is what will happen to the ECB's path for rates if the Fed's rate cutting cycle is delayed. Obviously, Kevin's already mentioned that our base case for a cut in the Fed is for June. And that aligns well with our view that the ECB also cuts in June. But if that is delayed, I think a couple of things are important to note. Firstly, I think the path for data in Europe has been very different to that in the US. European growth is pretty stagnant, and our forecast for growth for the year, even though it is higher than last year, is still a period of stagnant growth. So I think the growth picture is quite different, and inflation is coming down pretty quickly, as we all know. So I think that the tools and the information is there for the ECB to make the decision to cut rates at the middle of the year. They, of course, revised their forecast at the March meeting and marked to market a bit more than we had expected. So inflation is already at target in their forecast, both in the medium term. So a forward-looking central bank to that respect would have to cut rates based on those forecasts, and if the data continues to come in line. So I do think that the data is an important point to note. Secondly, of course, there's a concern about the exchange rate, but I do think that ECB studies and such have noted that the exchange rate impact should be fairly limited on inflation. So the euro area is obviously a pretty large amount of space. I mean, I think that the exchange rate is probably not the primary concern for the ECB at this point in time as well. So we do think that the ECB can cut ahead of the Fed in that respect. And lastly, I think, it has been done before, probably not in the best way, but I think, the economic data will determine whether the ECB cuts more than the Fed. And the ECB have been trying to make that point repeatedly, that the ECB does not have to follow the Fed. And perhaps rate cuts from other central banks, such as the SNB, for example, also prove the point that really other central banks don't necessarily have to follow the Fed. Now, the point at which this becomes an issue, I think, is if we actually have a complete delay to the Fed cutting cycle, so that the Fed doesn't cut at all this year, and that perhaps becomes more of a risk in terms of the ECB's reaction function. But I think if we see it as a delay of a couple of months, for example, what matters more is that the expectation is embedded that the ECB will cut and that the Fed will cut as well this year. So that probably matters more in our view. The second thing we talked about quite a lot was spreads. So both in terms of swap spreads as well as in terms of BTP spreads. I think the general point on swap spreads we were trying to make, and that we mentioned on the podcast before, is that we do think, of course, swap spreads have tightened a lot through this year. And the question really is, how much more can they tighten? One of the things that we think should or has reached its peak is how much cheaper collateral can get and how much that feeds into swap spreads. So because we think that the cheapening in collateral is limited, we think that factor should limit how much tighter spreads can get. But of course, other factors like risk sentiment, for example, can impact swap spreads tightening. And I think our clients generally were on the same page in the sense that they also felt like swap spreads had perhaps tightened enough at this point, and we didn't have too many people coming in opposing the idea that swap spreads should stop tightening at this point. I think over the last week, we've had a fairly interesting backdrop for swap spreads. They've been much more flat over the last week. So perhaps we're we're seeing that little bit of that in the flow as well. That swap spread tightening should stop at this stage. On BTPs, there was obviously questions on why they were tightening so much, and our key point really has been time and time again that BTPs as well have been driven by risk sentiment. I think it's not just BTPs that have performed, of course. OATs have performed, credit has performed, equity has performed. So it really is a risk story supporting risky assets, including BTPs at this point.
While there's been lots of central bank action everywhere, it feels like the euro area has taken a little bit of a backseat this week. But it was the ECB Watchers Conference on Wednesday. What were your key takeaways from that, if any? Was there any kind of major changes, I suppose, to the policy message from Lagarde's keynote speech?
The policy message the ECB continues to push and has been pushing since January, really, has been one of directing the market really towards a June cut. That's based on the fact that I think the ECB will have a lot more information by then. They'll have the wage inflation data. They'll also have a couple more inflation prints. So the forward guidance around June remains very much intact. But I think there's two interesting points to note from yesterday, so from Wednesday when ECB Watchers was conducted. The first one being that Lagarde did note that for them to cut rates, all that is required is for data to come in line with what they've put into their forecast. So we don't really need downside surprises, for example, for them to be able to cut in June. As long as the data that we get is in line with expectations, that cut should come. And I think that's obviously a very interesting point, because inflation is expected to moderate through this year, and we should get close to 2% by the middle of the year. The second point was just in terms of the sequencing of cuts. So there is this idea that if they start cutting in June, that doesn't necessarily mean that they cut every meeting from then. So I think in terms of how much cuts can be priced into this year, you could assume that, for example, they'll be more comfortable cutting at forecast meetings. So they cut 25 in June, and then at the preceding forecast meetings, meaning that we get 75 basis points in easing in total. I think that's fairly sensible. Our base case is still for 100 basis points at this stage, but of course, I think the risks can be skewed a bit towards fewer hikes if they are in risk management mode and don't necessarily want to cut too drastically, given that we expect growth will pick up over this year and that inflation is also moderating.
All right, let's wrap it up there for this week. Thank you both for joining me. Thank you to our listeners for listening in. Just a reminder, if you like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks, see you next week.